We'll go right ahead. All right, everyone, thank you so much for attending this evening to our webinar for our investor summary. My name is Dante Belmonte. I'm one of the managing partners of Victory Capital Group, for those of you that don't know me. And we've got my partner, DJ. DJ, would you like to go ahead and introduce yourself to the group that doesn't know you?
Yeah, absolutely. My name's DJ Smith. I'm also a managing partner of Victory Capital Group. One of the reasons why I'm really excited about the webinar here and to present this opportunity is I actually dabbled in a lot of different real estate stuff and really love this type of syndication investing. So I actually started as a passive investor, liked it so much, I gave up a full-time engineering job to do this full-time. So now I'm doing that with Dante on the active side and just love it. So really excited to have everybody on board.
Yeah, definitely. And just a lay of the land. So presentation we're going to go through for about 30 minutes. We just want to respect everyone's time. If you guys do have questions, either put it in the chat or preferably the Q&A section. And we're not going to answer them throughout. We're going to answer them all at the end, just so we can get through the presentation and just be as time sensitive as possible. And if anyone's looking to listen back to this, we're going to send out the recording to our mailer list tomorrow. Other than that, let's get started. DJ, you want to go over disclaimer real quick?
Yeah, so basically, there's obviously a lot of words on this page, but what it's really saying is, much like if you do stock investing, what we will going to do is put forth a business plan regarding a specific asset in Greenville, North Carolina, that will be structured under an LLC. The data that we put up on the screen are projections. They're not promises of returns. This is an investment. And we'll talk through some of the risks where we think we've been conservative. And we do think we've put together some conservative underwriting with some great upside and bought this right. And we'll get into that in the presentation.
Yeah, definitely. All right. Just some real quick overview pictures of the property. This is the entrance here, entrance sign. The next 4 photos here are the interior renovated photos. Some of the property or some of the units have back porches, and then this Tudor house style apartment complex. As you can see here, you have this timeless style, which is really great. And you'll see a little bit more about that. Table of contents. If you guys want to flip through this a little bit quicker, you can meet the team. You've met DJ and myself. Our third partner, John Azar, he is on the call. He currently has COVID, so he's not going to be doing too much chatting. He might chime in here or there. Shout out to Peak 15 Capital and John. John has syndicated thousands of apartment complexes, or excuse me, 1,000 apartment units over in the Southeast over the last 10 years or so. So happy to have him on the team as well.
Yeah, and Dante, the other thing I want to point out too, this is a 506B offering. And basically what that means is you have to have a pre-existing relationship with one of the sponsors. So these are our 3 sponsors. There is that prerequisite that you do have that pre-existing relationship with one of us. So everyone here has basically received a personal invitation. If not, we certainly invite you to listen in, but if you don't meet that prerequisite, you cannot invest.
Yeah, and hop on a call with us so we can get to know you and get you in some of these investments.
Yep.
Property overview. So not going to go over everything. We're not going to read it all. We're just going to hit the highlights. So this is a 32-unit apartment complex built in 1992. So not a terribly old asset. It's fairly newer. It is, as of right now, 100% occupied. And what that means is, obviously it's 100% occupied, but also the rents may be a little bit under market. Therefore, they filled it up very easily and keep it filled. So that means there might be a delta in rental amount. Current average rent right now is about $625. Market rents are pushing upwards of $700 and greater, and we will get into that here shortly.
Yeah, so for a business plan, we mentioned that earlier. What do we want to do with this asset? So we feel like we've acquired it at a great price. I usually break down the business plan into both interior and exterior renovations with the goal, obviously, of increasing the amount of revenue that this property can basically make. So really what we're doing, the whole approach of this, and our whole approach is to buy an asset, acquire an asset that operates in the black. This is a cash flowing asset that produces returns. Our goal is to improve those returns, improve the value of the asset, and then unload it in about 5 years. So the way we plan to do that is by executing on this business plan. We're pretty fortunate in that most of these units are already updated. We have about 8 units in their original condition that we will go in and make improvements on. We also have some exterior renovations that we'll do. The other thing that this property is not currently doing, so we look at underperforming assets, and why is this asset underperforming? The current owner is not charging market rents. They're significantly below market rents, which presents opportunity. In addition, there's some other typical fees in this area that you'll see in apartments, trash and pest fees, pet fees. None of that is being collected right now, as well as like water and sewer reimbursements, which will implement a fee for that. So the bottom line is that we plan on acquiring this asset, adding those elements as leases renew. And also we believe that we're conservative. In other words, we're not trying to push everything right to the market rates. That's probably too big a jump. So we've underwritten everything to increase slightly below market rates. And then once we reposition the asset, we only plan for about a 2.5% rent growth per year, which is also pretty conservative because Southeast, pretty hot market for rental increases year over year.
Yep. Awesome. And looking at key metrics. So again, not going to go over anything, just going to hit the key highlights. So when we're looking at multifamily, we're purchasing multifamily. We're saying, how much per door, how much per unit are you purchasing the asset for? So we're purchasing this property for $65,000 a door. Some comparables in the area for this same vintage and size asset and class in this area have sold for $75 a door, $85 a door. Those are two deals that I just saw trade. And earlier this year, a very similar asset that sold for $106,000 a door. So that gives us confidence in A, where we're buying below, or a lot of the market assets are being valued, and B, where we can sell this asset. And that comes down to having a good relationship with some smaller brokers, because these smaller brokers, they sometimes underprice the assets in our eyes, and we negotiated a pretty good price. So we actually had this under contract at $2.25 million. We were able to negotiate it down to $2,050,000 after DJ took his initial visit, and things weren't disclosed to us, such as age of HVAC units, hot water tanks, and the condition of the asphalt, which we'll get into. On this investment, it is a minimum of $50,000 investment. And then looking at the lower half of the page here, this is a 7% preferred return. So for those of you that are unaware, that means our investors get 7% annually before myself, DJ, or John get any split of the income as well. After that 7%, it's 75-25% split, 75% going to you guys, the investors, 25% going to DJ and myself and John after we hit that 7%. And that's on an annual basis. So if you only hit 4% year one, it's going to make up for the 3% you missed out on in year two. It's going to start to accumulate, is what it's referred to as.
Right. And that's 75%, Dante. It's split pro rata based on how much you invest in the deal. So if it's an $800,000 raise, you put in $100,000, you would get 1/8 of that 75%.
Yep. And then looking down here, your average annual return, 17.6% average annual, including proceeds from sale. If you exclude the proceeds from sale just off of running the property, or operations as we call it, that is about an 8% average cash on cash return. And we'll get into cap rates, assumptions, and a little bit more about these returns in a moment.
Yeah, but keep your eye on that cap rate, Dante. If you can go back for a second. So
Yep.
we've written a business plan, and that business plan is designed to return these numbers. And that purchase cap rate that you see, the 4.88 and the 5.88, keep your eye on that, because we're going to talk about that in a minute. It's like one of the biggest assumptions that we can make.
Yep, agreed. So why Greenville? Why are we buying in this market? Why do we choose to operate in this market? There's a few reasons here. One being population growth. That's going to be the largest one. We're looking for positive population growth. Greenville, North Carolina has grown roughly 13% since 2010. So it's putting up great numbers. The national average, so Greenville has 32% higher than the national average of renter population. So renter versus own, it's 32% higher in Greenville than the national average. Unemployment, 4.9% in Greenville versus 6% national. But we actually just rechecked the data this morning, and the new quarterly data came out for the end of last year, and it's actually 3.4% right now, unemployment rate in Greenville versus still the 6% national average. So those are all good things that we're looking at. Diverse job market. So if you look at that lower quarter of the screen, you'll see it's cut up pretty fair. It's not like 50% are all in retail or something like that, where if that job sector gets hit, it negatively impacts the economy. It's spaced out pretty well. As long as we see a majority of items under 20%, nothing higher, that makes us fairly comfortable. And the last item we're looking at is average household income. We want the average household income in the area that we have our property to be at least 3 times the rent. So if our rent's 1,000, we want the average annual income to be 3,000 a month. In this case, the average household income is 4.5 times our rent. So that just means that the majority buyer pool, or the average buyer pool, I shouldn't say buyer, I should say renter, will qualify for our unit. And if you look on the right side of the screen, this gives you a snapshot of where the property is and what's around it. So here we are, English Village, and going out to Target here, this is about 1.8 miles. So things we're looking at are these retailers, these restaurant businesses, for a few reasons. One, they're going to employ our residents. So our residents at a C+ class asset like this are going to be working at these places. And two, places like Chick-fil-A, Starbucks, Texas Roadhouse, Kohl's, they do a lot of research to find out where a strong area is, where strong demographics are, where growth is, where income and population is. And they're going to invest millions of dollars. They're going to make sure it's going to be successful. So as you can see around this corridor here that we're looking at, they've invested money here. And I can assure you that each of you have probably been to 1, if not 5 of these places in the last 2 to 3 months. And that's where a lot of people are going to be. So we're going to be able to put heads in beds by our complex here because of so much activity going on around here too. And they employ our tenants. So all good things we like to look at.
Good, Dante. Heads in beds. That wasn't in our pre-run up to this.
No, it wasn't. Yeah. And just continuing market overview of really where the migration's going. So you'll notice these blue dots here in the top 10 of population growth ranking. So, and you'll notice red, it's on the bottom 10. So a lot of people are migrating from the Northeast down to the Southeast. So places like North Carolina, South Carolina, Georgia, Florida are generating individuals from that Northeast to that Southeast, which is great. And then you look over at California and Texas, Arizona, they're pulling people east. They're pulling people in from the West east to Texas and Arizona. And you can see that here. So this map gives a good visual on where that migration is coming to. And Greenville really qualifies to this rally dot here. It all kind of hones in on where the data is pulling from. So another, again, a great visual.
Cost of living, right? Taxes in some of these states, it's literally driving people out. I mean, you even have places like Boise, Idaho right now. Their real estate market is booming. These trends are not going to stop anytime soon. New York's not going to change their structure. There's just no sign of it. California, the same thing. You know, hopefully they do for their own sake, but for now, this is an opportunity we can all capitalize on that's really driving the fundamentals of apartment investing, like what we're presenting here.
Yeah. And last, this deal aside, last deal aside, everything we're looking at is on these base fundamentals where we can come back to. So very important.
So in terms of some of these interior renovations, first of all, we have 32 units in this apartment complex, split evenly between 2-bed and 1-bed units. On the left is an example of what a non-renovated unit looks like. On the right is a renovated unit. So I think what's really important to note here is we can't outspend what this community can recognize and value. So really, we're doing light renovations. They just require a light update. These units are actually very spacious for their size. They feel spacious because they're open. So the plan is to go in, leave the existing cabinets, update appliances, update some of the electrical fixtures, flooring, new paint, and that's basically it. So pretty simple renovations. We feel like we can turn them around in a week or 2 max. The plan is not to vacate those 8 units all at once. We'll just do it as leases come due.
Yep.
Dante, one other thing I want to point out here too. If you look at the renovated photo, that table at the bottom, we mentioned the targeted rent for the 1-bedroom and 2-bedroom. That target rent is below what the market rents are at. So it's a conservative assumption of where we think we can get these to. It's not a huge increase. It only represents about $60 per month. Pretty reasonable.
Agreed. And something else I forgot to mention, we were talking about the market. Last week, if you saw the email I sent out, there was a $300 million development project just announced right by our property here in Greenville. So that's some other positive stuff there. I forgot to mention that. But
Yeah.
DJ, yeah, keep going.
Yeah, love it when new investments come in. So we had mentioned that when we first went to look at the property, there were some things that weren't disclosed. Two of those things actually end up being some of our biggest CapEx areas of focus. One is the first thing we're going to do is go in there and repave the parking lot. It's not in good shape. It has some tree root intrusion. Goal is to save the trees, put down some new asphalt, fill the holes, and so on. That's going to do a couple of things for us. It's going to, first of all, fix a problem. Second of all, it's going to present a great look to the property for any new prospective tenants coming in, and also show existing tenants that, hey, as new owners, we're serious. We're serious about giving you a great place to live, and hopefully they just jump on board that and continue to appreciate it and appreciate the place that they're living. The other thing that we're going to do, HVAC units, there's a lot of them there that are older. So a major area of our CapEx is going to go to when we first get in there, taking a group of some of these older air conditioners. You see the two in the middle, replace some of those older units, some of the older hot water heaters, so we don't have any water leaks in the facility. And that's basically it. So there's some other minor stuff. We mentioned tree trimming. That's really to protect the roofs. But pretty simple here from an execution standpoint.
Yeah, we're very proactive. Whenever we come into a property, we instantly start investing some capital in it. So the residents can see we're serious. We're trying to upgrade the place. And B, we just like nice looking communities. There's more value to be had there as well. I'm personally really excited to get this new parking lot in because that's just instantly going to transform the place. It's going to look awesome. So I'm excited for that. And looking at rent comps. So again, won't go over everything. Blue bars here are 1 bedroom, 1 bath comps. Yellow bars are 2 bed, 1 bath. And then here we are down over here. So really what we want you guys to focus on is averages and where we are at. So average vintage of property we're comparing with 1993, we're 1992. And our 1 bedroom square footage is 640 and 2 bedroom is 780. The average on the 2 bed square footage is 756 and then 679 on the ones. Very, very small amount difference in square footage. You could call it the same. But what we really want you guys to look at is the asking rent. So right now, 1 bedrooms on average are asking about 680 a month. 2 bedrooms are averaging about 800 a month. We are, what I like to say, well below that at 735 on the 2 bedrooms and 635 on the 1 bedrooms. If you're taking that square footage approach, we're below $1 square foot, where the average and a lot are above the $1 square foot. So this is where we can say we are conservative in that sense, that we believe our rents that we can achieve are lower than the rest, and our rent growth being only 2.5% annual increase is also very conservative. When we were going over with our property manager what the business plan was and how we plan on growing rents 2.5% annually after stabilized, he kind of laughed at me and he's like, that's really low. And I said, that's fine. It can be low. If we beat projections, that's just going to make for better numbers for the project.
From an underwriting standpoint, it's one of the best compliments we can get is when somebody says you're being really conservative. And all we can say there is thank you, and our investors benefit from that.
Yep, definitely.
Yeah, so sources and uses of capital and our debt structure. So you see the column on the left, or the bar on the left. Basically, what we're doing is for our total project cost, we're going to basically what we're going to do is we're going to get a $1.743 million loan approximately. And then the equity raise is about $800,000. One of the big differences between this and our prior deal is the type of financing that we've put in place. So we always have a decision to make with regard to financing. We talk to a lot of different sources. We look at both short-term and long-term. For this particular project, the best move for us was to use a form of financing called our bridge financing. You can see on the right-hand side, the interest rate, 5.99%. Now, some people may feel like that's high during this climate. If we went with more permanent financing, such as agency lender or something like that, If we could secure that financing, the rate would be lower. However, they would not loan us the CapEx dollars that we need. So the benefit there is, even though the interest rate is a little bit higher, we can actually get more money cheaper. So we can
And that
raise
CapEx, for people that don't understand, that's that part, paving of the parking lot, HVAC units, interior renovations, any money we're investing to the property. Go ahead, DJ. Sorry.
Absolutely. And if we had to raise it from some of the LPs, the people considering the deal, basically we'd have to pay a higher return on that money. So while the interest rate is slightly higher, we still feel like it's a really strong competitive rate. It is a fixed rate. It's not variable. And we can actually hold that rate throughout the life of the deal. So you see the term at the bottom, it's for an initial 3-year term, and we have 2 1-year options. Also, after 18 months, we don't have any prepayment penalty if we want to change out to permanent financing. So as part of our business plan, one of the things we plan to do with this deal is to actually return a portion of your capital about the end of year 2. So we do plan on to refinance out, hopefully into cheaper debt. We'll keep an eye on interest rates. We have the option, but the goal here would be to actually return about 40%-ish of your capital after year 2 that you can put back and invest in something else while you still remain in this deal. And we'll get into that a little bit further here in a minute.
Yeah. So a few things to highlight on that. One, interest rate 5.99%. Oh, that's high. Someone might say, well, if you're familiar with hard money lenders or private lenders, they're lending right now at anywhere from 8 to 12%, really on the higher side because of interest rates have gone up. So we're half that. So that's actually a very strong rate for such a small asset, when in reality, this is on the smaller side. No prepayment penalty after 18 months, like you said, DJ, and a fixed rate. So as we are in an increasing interest rate environment, that doesn't affect us on this loan type because we're locked in for 5 years at least. So we have the 3 years plus 1 plus 1. So we have 2 1-year extensions, like you said, which is great.
Yeah, Dante, plus the interest only is also important. We're not interested in paying down our principal at all. We're going to create value. This, just like a business, it's based on the amount of income. This is unlike investing in a single family home or a small multifamily where they're going to run comps. That's not how these properties are evaluated or valued. They're valued based on how much income they produce. So Correct. If we can force the property to appreciate by executing on the business plan and increasing the income.
Yep. And talking about income and expenses, here's a quick snapshot of the property right now. So it's historical income and expenses, and then our 1 to 5 year projected income and expenses. So again, I won't review all of this. We really just want to highlight or let you guys see what's going on with the property. But one thing I want to highlight here is year 3, we're projecting a 70% increase in taxes. Do I think we'll get to 20,000 from the 13 it's at right now? I don't believe so. But again, I like to overestimate on certain expenses like that. So the numbers look a little bit better if we don't hit that. So the biggest trend here, net operating income, what really dictates the property value, it's going to consistently increase, with exception of a $500, $600, $1,500 decrease in year 3 because of that tax increase. But again, if that doesn't happen, we'll continue to increase at a steady pace where the asset will continue to increase as well. So
and a quick note on the historical, the existing owner hasn't disclosed everything to us. I don't believe. I think his numbers are artificially low. So some of those blanks that are in there and so on, they may have it in some other categories, but we do believe his expenses are low. So what we do is we know what our expenses are going to be. Those numbers are pretty hard and fast. We get quotes, we talk to people and are pretty dialed in, including what Dante had said about talking to the local tax department.
Yep, exactly.
So cost segregation, depreciation. So this is for our cash investors. You are allowed to invest through a solo 401k, through a self-directed IRA. If you need any assistance with that, you can certainly reach out to us and we can guide you through and help you with that. But for our cash investors, one of the great things about real estate investing is depreciation. These assets are depreciated over 27.5 years. And then we also work in this other thing called cost segregation. So basically we hire a firm that'll come in and do a study and depreciate certain items appliances and so on, maybe the roofs, whatever it is, they do their magic. I'm not going to pretend to be an expert there, but what it does is it front loads the appreciation and helps, because not only are you going to see the returns that we project, but in addition to that, you basically give Uncle Sam less money. So I've noticed this on a few of the investments that I'm in. It's really great because on paper, I'm showing a loss, yet my account value is going up. It's kind of the magic of real estate, and I think it's really great. It's something you should certainly talk to your CPA or tax advisor about.
Yeah, and this isn't something you can access in the residential world if you have a duplex or a quadplex. It's just the numbers won't make sense to absorb the cost of this study. So with these larger assets, we're able to take advantage of that and those tax benefits. That's very unique to this type of asset class.
So this should be the where the rubber hits the road slide. So I'm really going to talk about three things here. If you look in the left-hand corner under investment basis, underneath that is distributions from operations. So early on, Dante mentioned cash on cash return. You can think of it like a value stock that's going to pay you a dividend. Value stocks will typically give you, a few percentage points per year. What we're going to do is we're going to pay out quarterly numbers, which will hopefully meet or exceed what we've put under year 1, 2, 3, 4, and 5 under distributions from operations. It's basically the distributable cash flow, what's left over after we collect the income and pay all the expenses. That's shared with investors. Again, investors are prioritized. We mentioned the 7% preferred return. The GP team doesn't make anything until the limited partners get that 7% first. So that money flows back to you throughout the hold period. The second thing I'm going to talk about, we mentioned a refinance. So the next line below that, return of equity from refinance. We mentioned about 40% of your money coming back, the 42,773. So all these numbers are predicated on the business plan that we've prepared. We believe the business plan is conservative. That number could go slightly up or down, but the benefit here is returning your capital as quickly as possible so you can take that money and reinvest it. And then you stay in this deal, continuing to generate that cash on cash return of the distribution from operations. But I always say the golden nugget or the golden pot of gold at the end of the rainbow is when we dispose of the asset, when we go to sell. So proceeds from sale, Dante almost highlighted it correctly, the 59,546. So we do this based on $100,000 investment, just because the math is simple. Again, the minimum investment is $50,000, but if you put $100,000 into this deal, when we go and return all of your capital in year 5, you would also receive a bonus payment of $59,546 or thereabouts, predicated on the assumptions that we've made in the business plan. And we're going to talk about that here in the bottom table in just a second. The other number I wanted to point out to you is total return on investment. So Dante will highlight it here in a second, the 87,790. Basically what that is, it's all the cash that you receive, distributions from operations, or what we call cash on cash, plus the proceeds from sale. So when this deal closes out, your investment is returned, plus about another $88,000 in a 5-year period, or what we call a 1.88 equity multiple. So pretty strong returns, pretty great job by real estate, but it could potentially be better. And the reason why I say that is if you look at that bottom table called stress testing the investment, we've underwritten this deal. If you look in that cap rate column, 5.88%, or what we call a 5.88 cap rate, that's basically an assumption around what we assume that the asset is going to sell for. It's a very conservative assumption. In fact, Mr. Azar, our other co-sponsor, when I asked him this question, he said, market like Greenville, maybe 15 basis points a year, you should add on to your purchase cap rate. That would put us about, what, Dante, 15, 30, 60, about 75 or 0.75. We're actually a full point higher. So we believe this is a very conservative return that would produce that $88,000 return. Let's assume for a second that things stay strong, the market stays compressed or cap rates stay compressed. The thing to remember is that cap rates are inversely proportional to the value of a property. So we want, when we sell, that cap rate to stay low. If that cap rate is at a 5.24%, total returns could be 122,707. An equity multiple of, what's that, Dante, 212-ish?
2.23. Are you saying that the 5.24?
Yeah,
on the
I'm sorry, you're right, 2.23. Okay.
Mhm.
You know, if I'm to look at this table at a 5.88 and say right now, even with some of the economic uncertainty going on, we still see the fundamentals in multifamily being very strong. And if I was to venture a guess as to which way this table would go, I say it's more likely to be compressed than decompressed. In other words, more likely to go down than up. But we certainly want to show a number that we feel like we can meet and beat.
Yeah.
So really important there. And this is probably the biggest assumption. If you're looking at investing in multifamily, if you're looking at syndications, this is the first question I ask when I invest passively. What's your cap rate that you're buying at, and what's your exit cap rate?
Yeah, no, that's great. And, let's look at the other end of the spectrum. If cap rates started to decompress even more and went really high, let's say we're over our estimate by 40 basis points, you're still getting a 13.5% average annual return. That's still better than what we're seeing in the stock market year to date or the last 6 months or 8 months. It's been rough. And something I want to go back and touch on is that refinance. So essentially, we have three options after year two. We can keep the debt in place, we can refinance the debt in place, or we can sell the property. Year 3, 4, we have the same option. Keep the debt, refinance the debt, sell the asset. Year 5, we can refinance or sell the asset. So what I'm getting at there is we have multiple exit strategies. We're not pinned to a corner where our loan is due in 12 months. We have a big prepayment penalty that we have to pay. So there could be an option where the market isn't as favorable or the asset isn't running to where we need it to be. And we decide, instead of doing a refinance in year 2, we keep the capital at hand. We'll still get very similar returns that you see down below. You just won't get roughly 50 or 40% of your capital back. Our conservative approach, where we think we're going to land, roughly 40 to 50% of your capital will come back at the end of year 2 when we refinance out of the bridge loan. Or if the market continues to do as well as it is and we continue to operate or will operate this property at a high level, maybe you get 100% of your capital back and you still retain your position of equity in the deal, and you get free flowing cash flow from the asset for 3 more years, and it's tax-free. That cash out refinance is tax-free. It's a non-taxable event. It's return of capital, not on capital. So you can take out that 50%, or like I said, maybe even 100% or somewhere in the middle, and you can go throw in another deal. And now your money, the same money, is working for you in 2 places. That's the power of real estate. And that's the power of this project here. Moving on to property management. So who's going to be
Dante, I'm laughing at the table. I'm trying to do the numbers in my head, and you got it in 2 columns over.
Yes. Oh, yes. Yeah.
Thank you for that. You're always well prepared.
No problem. So looking at property management. So obviously DJ and I, we're not hands-on, boots on the ground managing this property. We hire professional property management company to do so. So we've gone with Connolly Properties. They've been in the Greenville market operating for over 14 years. They manage over 700 units in this market. And on this street, P Drive, that we are purchasing this asset on, they manage a lot of the assets on that street, which are all renting for higher than this asset here. So we've got some immediate data in the area. And not to mention, the individual that runs this property management company, owns it, and met with us and walked all the units, is the mayor of Greenville. So you literally cannot get anyone better to run your property for you than the mayor of the town you were in, the city you were in. So
you certainly can't get better intel.
Correct. Yeah.
And he's also managing the property right next door.
Mm-hmm.
So extremely familiar with the local area. It's a great connection to have. Good guy. People seem to love him. So we're really excited about that.
Yep. Agreed. And looking at next steps. So step 1, we are at the webinar right now. We're listening to that. Step 2 is going to be the firm commitment due. So March 29th. What do you have to do by March 29th? Well, you have to make your reservation in our portal, which I'll show you how to do in a moment. and then you have to fill out what's called the subscription agreement. So we don't have the subscription agreement right now. Our SEC attorney is finalizing that. Once we have that, we will forward that to everyone that has made a reservation, and that is due by March 29th. Then your funds are due by April 5th. So you have to wire those funds to our escrow account by April 5th. I definitely want to focus on the fact that this is a first come, first served basis. So what that means is you need to have your reservation in first. You need to have the document signed, and your funds have to be wired to our escrow account. If those three things are not done, that does not reserve you a spot. So all three things need to be done. This is a smaller offering. Our last offering was 1.2 million we raised. This one's only 800,000. So I say that to say it has to be a first come, first serve.
Well,
I'm emphasizing that.
Yeah, here's what I'll say about that. We never want to force anyone. We would never do that. We believe, if you believe in the power of commercial real estate and what multifamily can do for you, we'd love to have you participate. The only fair way to do it is to say, when everybody's funds are in, that's who gets in first. We can't overraise the deal because it diminishes the returns of those that are in. We're certainly happy to help people walk through this. And so whatever you need, we'll put up our contact information here in a second. Dante's actually going to show you how you do your soft commit or your reservation. We certainly love to have you on board. And, we just, like I said, I started doing this passively to the tune of about 1,200 units. It's going great. I love it, and decided to switch over to the active side.
Yeah. And looking at April 20th for the on or about closing date. So if anyone's in real estate, sometimes things get in the way, some legal documents, and sometimes we have to push it a little bit farther or something with the loan. But these are our dates here, and we're going to stick with those, and we'll go from there. So next, before we get into questions that you guys have,
Dante, I do laugh because if anybody goes onto these types of presentations when syndicators offer up properties, they all say it's going to fill up quick. And I want to be very clear that this one likely will. So if you are interested, you should act fast. I'm not saying that just to
sound like all the rest, DJ. Come on.
I know, but we would never do that. That's not how we're wired or built. But I do believe, because this is not a huge raise, we do have a lot of interest. You're going to want to move quickly.
Yes. So if you're looking to get a hold of myself or DJ, there's our personal cell phones and emails below. If you would like to talk to us more about it or ask questions, feel free to, if that's something you don't want to ask in here. So this PDF that you guys all got sent, this is a clickable link. So if you're interested in the investment and you want to make a reservation, this isn't completely signing you up. So if you make a reservation and decide you don't want to move forward, that's fine. You'll click this link here, and what it'll do is it will take you to this page here. So this is our portal. You're going to get some photos of the property. So to give you guys a better idea, this is the center of the property here. You've got, these beautiful buildings, these Tudor style buildings, really, really good shape. It was a nice sunny day when I was down there last month, not missing Syracuse. Give you an idea for the building here. And then the interiors of the units as well. So you can see what that looks like. On the right side here, it's going to give you some key highlights of the property. It's going to show you on a map where the property is. So we were showing you all that. Retail and restaurant is literally right here. It gives you a little breakdown of the property. And then down here, we will put the link for the recording for this webinar that will get edited in by tomorrow. But then what you'll do is you'll hit reserve now. So if you don't have a login, you'll be prompted to sign up. If you do have a login and you've invested with us before, you'll log in here. I'm going to go into my personal. We'll hit reserve now. So this is important. And so investing as, this is very important that you guys see this. I hit add a new profile here. So this is going to allow me to choose either my IRA, because I can invest with my retirement account, an entity such as an LLC, an individual such as myself, or maybe you have a trust, a joint registration, meaning with a spouse, and then a retirement plan. We don't really see the retirement plan. Everything above we have seen. So I'm going to click individual. If I don't have myself individually filled out, I'll do that here, but I already have, so it's saved in there. and I will select myself my investment amount. The minimum is 50,000. Let's put in 50,000, reserve, and we're done. So that's simple. So you can actually go to invest, and it's going to show you that offering, and it shows what you've put in there for reservations. Again, view details, reserve. So what this does is it's going to put you on our list. So we'll email you that subscription agreement when we are ready to go. With that, do we have any questions in the chat? DJ, it looks like you're playing with one already.
Yes. Yeah. So Kelly asked about, as an estate planner, what happens when an investor dies? How does the family get the investment back? Basically, what I'm saying there is, I probably a better question for an attorney, but nobody would lose their investment. Having dealt with estates before, basically, when I've had an individual that I've been an executive for, basically those returns would go to their estate, and we would we do not set up where there's beneficiaries or anything like that. So it would go to their estate, I guess, is the short answer.
Yep. And then we had a question here. If interest rates are higher in 5 years, which could impact the sale price negatively, very correct. Is there an option to hold this asset beyond 5 years and sell at a better time? Or is it set to sell regardless at 5 years? So that's a great question. We do, I believe in our documents, DJ, I think we said 3 to 7 or 4 to 6. So
6. Yeah.
Yep. So the only reason why we do that is to give us a range. So if the market's really strong and we can sell year 3 and capture the returns for year 5, we can do so, because we know if we sell in year 3, it's less of a chance of a market decline, and we can end that cycle on a high note. But like this individual said, in year 5, if the interest rates are a little higher and negatively impact the sale price, which I'd like to point out, the sale price that we chose to sell this asset at, which is only $3 million, $1 million more over 5 years, is very conservative in a rising interest rate environment. But yes, if it was negatively impacted, we can hold this asset out for 6 or 7 years. Here's an idea. End of year 2, we refinance and we pull out a lot or all of everyone's capital. Why not just continue to cash flow the thing for another 5 to 6, 7 years? That's just free checks coming in the mail each quarter. But great question. Brian asks, when refinance in year 2, will the loan be interest only again or longer term debt? How equity do investors have in the deal after refinance? So on the new loan, we are projecting to get 1 year of interest only. It's pretty standard with the lender that we are going to, which is considered a Freddie SBL loan. Could we get 2 years? Yes, but we're going to be conservative and say 1 year. How much equity do the investors have in the deal after refinance? You keep your same percentage of equity, so it doesn't get diluted if you get all of your capital back or part of your capital back. That defeats the whole purpose.
We don't change the waterfall distribution.
Correct.
It still stays the same with the 7% preferred and then the 75-25 split.
Yep. And then you had a good second question here. If you can get more than 735 for 2 beds, will you, if income exceeds projections, do investors returns increase? Most definitely. So our goal is to hit as high of a income threshold as we can, and that will translate directly to the return. So again, we don't keep any additional income we make. The first 7% annually goes to the investors. Every dollar after that gets split 75 to the investors, 25 to ourselves. So if we can achieve, let's say, a 10% return, that 7% goes to you guys. That additional 3% gets split the 75-25. That pref and increase in the income just motivates us to want to make this asset function at a higher level, because that's going to increase the income for not only ourselves, but everyone else, and the actual income for the property. Terrence said, how's crime data for the area? So Terrence, we look at 3 different websites for crime data, and we will not invest in an area with high crime. That is one of my big no-nos. I just released a podcast episode last week talking about it. There's no number, but we look at that immediate area. We look at the last year, 6 months, and see how much crime has actually gone on in that immediate apartment complex and the surrounding area. And if we're not comfortable walking the asset to, inspect it, or if there's a lot of crime around there and we see that, we just won't do the deal because it's not worth it. It won't hold its value. So right. I hope that answers the question.
A couple other things we'll add. When Dante and I went for inspection day, we drove in there after midnight, and
at 1 a.m.
Yeah, we went to the property and said, let's see what's going on. Is there anything we should be concerned with? Very quiet. It was well lit. The other thing I'll point out is we got local intel from the mayor. So, not only did we look at the data and the reporting that's out there, we went and experienced it for ourselves, as well as getting some great local knowledge.
Yeah, I'd say that that's the biggest thing. So when we were coming in 1 a.m., I was like, let's go to the property real quick and check out, see how it looks at night. Is there anyone hanging out? And it's very, very well lit. I was very impressed with that. And that makes me happy. Especially for the residents, they feel a little bit safer. Joe asks, is there an investor trip planned? I think that'd be awesome if we rented like a coach bus and took them to all of our assets. But I think on this small of an asset, I think it would be more of a hindrance to the residents, and they'd kind of be like, they think we're like at a zoo or something, and we're like viewing everyone as we go through. So no investor trip. You have the address. You're more than welcome to swing on by, check it out at 1 a.m., see how it is at night, and let us know what you think.
Yeah, and certainly too, if you want to reach out to us, we've done this on other properties before where some of our investors have said, hey, I'm going to be out there. We'd love to meet you out there, take you to lunch. If it works for us, we'll certainly do that. If I was investing in the property and I have the ability to get there, I go. So I think it's a great call.
Yeah. And then Phil said, any assumptions or red flags for the favorable purchase price given the current market, besides explaining mechanics and parking? So Phil, DJ and I were having this discussion last week. We target smaller brokers that are selling deals because their mailing list is smaller, their buyer pool is smaller. So these assets don't get listed on an open MLS or the open market. They're private sales. So we target smaller brokers because their buyer list is smaller, therefore there's less competition. And sometimes they're really not maximizing the pricing. So if we're approaching brokers like Cushman and Wakefield, Capstone, CBRE, they're typically they're much larger. Their buyer list is literally hundreds, if not thousands deep, and they're able to bid up these prices much higher. So those assets that recently sold at the 75, 85, and 106,000, those were larger shop brokerages that had a much larger buying pool. Just to do a test, I tried searching for the brokerage we bought this property from, and it was like pulling teeth just to get them to come up on Google or Facebook. So this is a great thing because we can build relationships with them. And they also want to know how much experience you have. So when we came in, we had really good terms. We had a very strong deposit. I believe we put a deposit down for $50,000. I think it was, DJ, which is greater than some other groups had. So all this tells the broker is we're more serious. They know we own assets in North Carolina already. They follow us on social media. They see the content we put out, and they want to close the deal. They don't want to get a month down the line and say, oh, this group has to retrade, or this group wasn't able to close the deal or get the loan. They know all those boxes checked with us. And it's something else we do. I flew in a few months back, and I took one of the brokers out to lunch with DJ just to show, hey, we're serious. I came from New York just to take you out to lunch versus some other guys that probably just flopped in your email and said, hey, you have any deals coming up? We were in person, we shook their hand, we let them know how serious they were and toward a few of their assets. So Phil, I hope that gives you a good answer to your question there.
Yeah, Kyle asked about timetable on remodeling work post-close. Do you anticipate any delays due to supply chain issues with HVAC materials, contractor issues in a hot market? So this is another great question because contractor issues can be a problem. So a couple of things there that we do to mitigate that. One is, the first thing I say to contractors is we love to pay our contractors. So the goal with all of this is always to get them paid as quickly as possible. So one of the things we did in our last project is show up weekly at the site, ready to write a check based on the amount of work complete or based on their percent complete. So money talks. And if you can get these guys paid quickly, they don't have to wait for an invoice to be processed and, net 30 days and all that stuff. So that's one way we can leverage that. The other thing we never do is we never get out in front of these people. We never pay them for materials unless they're on site. We never pay them for work that's not done. We always hold back enough to finish the job should they disappear. So that's really important to us. And I think that's how we can mitigate. Are they backed up? Yes. I think the good thing is with regard to some of the some of the improvements that we're going to do, none of this stuff has to happen overnight. And we're already in the process of scheduling it right now. So by giving them plenty of lead time, we help mitigate that. We get ourselves into the queue. We make for arrangements on payment terms. We always go over scope, schedule, and price, and then talk about how we're going to get them paid. That gets them motivated. Could they push us back and so on? Yeah, absolutely. But we also get more than one contractor in the queue. So if somebody falls through, we have somebody waiting in the wings.
Yeah, and you said it really well. It's none of it is time sensitive. So yes, supply chain issues are definitely a factor right now. I'm building a house. I know it's a factor, but these aren't time sensitive. So we can try to order material and it doesn't have to happen right away. So we can try to do it a few months down the line. And we're also buying some materials in bulk. So sometimes they'll put us at the top of the line versus the guy that's just buying one thing. We can put in a larger order that's more prioritized.
And Phil shows up with Rustin Paving. You're right, Phil. I should have called them.
Any other questions, Brian? If anyone else has questions, please put it in there.
And Dante, just to finish that up too. So in talking to our HVAC contractor, who, by the way, when we do these inspections and when we do underwriting, a couple other things everybody should know. First of all, one of the first individuals that reviews our underwriting is our co-sponsor, John, and his team. We bring the deals to him first. He underwrites it. The lender also checks our underwriting. So you don't have to just, assume that it's Victory Capital Group doing the underwriting for you. It's checked and rechecked. Also, when we have inspection day at a property like this, we're there with the property manager. We're walking in every single unit. We're there with an HVAC contractor. We're there with a plumber. We're there with an electrician. We're there with pest control. So you're not just relying on DJ and Dante and whether or not we can spot bed bugs, right? We get the experts there. We talk to them about pricing. We talk to them about lead times. We get quotes in hand. So will a mechanical equipment be an issue in terms of lead time? At the time we were there and had the discussion, not an issue as long as we're not trying to do it by tomorrow. So if we can just schedule things out, get them to cycle through one unit at a time, they basically would put one crew on us, go one unit at a time for the ones that want to be replaced. We show up weekly, pay them for the work that's done.
Yeah. And Brian's asking, he thinks he missed it. Where does he make the reservation? So in the bulk email that was sent out, you will go to the last page of our investor summary. This is a clickable link. You'll click that and that'll pull the reservation right up for you. And if for some reason you're unable to find it, let me know and I'll email it to you directly. What other questions? Anything else you guys have? I'd love to hear them. I'd love to talk about them. And maybe it's something we missed ourselves. I'd love to chat about it.
Yeah, and if anybody didn't get the link, if you found us in some other way, you can just go ahead and type in the chat your email address and we'll make sure we send it out to you.
No other questions? I guess that means we did a good job if we answered everyone's questions then, right, DJ?
You did a good job, Dante.
Oh, thanks. Thanks. You too. So again, make that reservation. First come, first serve. We'll keep you updated on when that subscription agreement comes out so you can fill that out and then wire the funds over. Tomorrow afternoon, we will email this recording out. It's a private link on YouTube, so you can check it out, rewatch if you want to see something on here. And then everyone should have a copy of this executive summary or the investor summary so they can go back and look at anything they'd like to look at. We'll give one more chance for any questions anyone has. Other than that, we'll sign off.
Yeah, Dante, I think the other thing is too, if ongoing communications. So first of all, we're excited to put this team together, and it truly is a team effort. We can't do it without our private investors. And we certainly enjoy the communications that we have. And the way we go about doing that is we'll do monthly email updates. They'll be fairly simple, a little bit more detailed quarterly that will have some more financial information as we get ready to process distributions. We also right now are doing at least once a year and possibly twice, just putting everybody on a Zoom call, do an annual meeting, let people ask questions. And obviously we're here. You have our direct contact information, our cell phone numbers. If you have any questions, whether it be just an educational thing or whether you want to know more about this specific investment or an investment you're already involved in, happy to talk to people, educate, Again, we just really believe in this form of investing. We think it's great, and would love the opportunity to partner with anybody that's interested.
Yeah. Give it another few seconds for any questions. If not, we'll close it off, and we thank everyone for taking the time to hang out with us this evening.
Yep.
What percent of LP money goes towards prepaids, closing costs, reservations, acquisition fee, CapEx? It's really, the answer is all of it, because that 800,000, if we can actually, we'll go back here and show it perfectly. So sources and uses, you'll find this in our legal docs. So out of 800,000 and the debt of 1.743, you add that together, both those numbers will match all of these numbers. So you'll notice here, all of this right here, working capital reserves, closing costs, prepaid, acquisition fee, and CapEx, technically that's all coming out of the capital raised of LP dollars and personal dollars that we're investing in this deal. I want to make that very clear. We put capital in the deal. And then the majority of the purchase price / CapEx is really going to be debt. So if you try adding up this number, this number, this number, it's not going to come to that 800, because you also have this number, and then we put a percentage down on the property. So we put 25% down on the property. So call it on that 250 million.
Oh boy, he's got the calculator going.
Oh yeah, here we go. I have like 6 calculators on my desk. So you're talking almost $500,000 of that goes towards the down payment. So that remaining, call it 300,000, goes towards the that 500,000 goes towards the down payment. The other 300,000 gets broken up between, prepaids, closings, working capital reserve account. So I hope that answered your question. Sam,
Yeah.
To answer your question on how much cash the GPs are putting in, I'm putting in 50,000 personally. DJ's trying to figure out how much he wants to put in.
DJ's also doing 50,000 on this.
I'm sorry.
I said I'm also doing 50,000 on this.
Okay,
Yep.
perfect. So
Yep.
we're doing 100,000 of the 800,000. So it's not over the 800,000. So it's already down to 700,000. It's a smaller offering, but if it's such a good deal, we want to put in capital. So we want to be part of this. So we like being on the LP side as well. We believe in it so much that we're putting our own capital in, and not to mention the amount of money that goes in day one, hard deposit, lender fees up front. So I think we already have personal funds of $75,000 in this deal. And the last deal before it even closed, we personally put in $125,000 of our own funds in it. These are smaller deals because, Sam, I know you're used to some bigger ones, but we put all the at-risk capital up, hard money day one usually, and then we usually leave the majority of that into the deal to build our own personal portfolios.
That's a great question, by the way.
Else? Oh yeah, and the investors should have equity in the deal.
Phil's
Or
already,
the GPs.
Phil's already ticking off the.
Yeah, he's like 800 down to 700. Bing. Yeah, and we already reservations. I won't even mention that, but it's exciting. So all this means is we have lots of investors that are hungry for deals, and we've got more in the pipeline that we're working on. We've got a lot of interest, which is great, and we're very blessed to have that. Real quick, any more questions? If not, we'll have everyone sign off here.
Thanks, Brian. Great questions.
Well, guys, thank you. Appreciate it, guys. Hope you found some value. If you're not investing, we're happy to let you guys know what we're doing, and hope you took some value away. If you are, happy to have you. So other than that, I hope everyone has a great evening.
Awesome. Thank you, everyone.